Good afternoon, everyone. Thank you for joining the 2017 ULI Thought Leadership webinar, where we invite some of our corporate members to share their new concepts, ideas, and best practices with our members. Before we kick off, some general housekeeping. This webinar is 15 minutes, and there is no question and answer portion at the end. However, you're welcome to email us or type all your questions into the box that's been provided through this platform. We will collate and share them with the presenter to connect with you individually following the presentation. Please also be reminded to stay muted as to not interrupt the speaker, and this presentation will be recorded. And now, I'm pleased to introduce Andrew Haskins, Executive Director of Research and Advisory for Asia from Colliers International, to discuss about the shift in capital flows, with expectations of slower renminbi depreciation and political pressures causing Chinese investment to shift back towards Asian markets from 2017. The outlook is positive for the Asian property market. Over to you, Andrew.
Ladies and gentlemen, good afternoon. Thank you very much for joining this webinar. My name is Andrew Haskins. I am the head of property research for Asia for Colliers International. My colleague Elaine Liu and I have done a considerable amount of work this year on the subject of Asia to global and global to Asia and Asia to Asia property capital flows and what the outlook for those flows is. I hope that you can all see the presentation on the screen. If you look at the first slide of text entitled Overall Conclusions 1, we summarize our overall views on that page. Let me just go through that very quickly. This really is the only page to which you need to pay considerable attention, and by all means stop listening after that. But if I just run through the key conclusions, heavy Asian investment in property in other regions in recent years has been led by Chinese groups and heavily focused on the United States. That investment outside Asia has obscured strong and rising intra-regional, so intra-Asian capital flows, which last year were actually 18% higher than the Asia to global flows. From this year, 2017, we expect slower renminbi depreciation and possible political pressures to cause Chinese investment to start to shift towards Asian markets. Now, if that is so, then the continuing weight of investment capital should offset likely rising cost of funds so that property yields on average stay flat across Asia in 2017. Initial indications for the first quarter of this year broadly support our view, and I will come back to that point later. So far as Asian property in general is concerned, we remain positive and we see particular investment opportunities in China, Hong Kong, Singapore, and India. If you look at the following slide entitled Overall Conclusions 2, you can see a graphical presentation of sources of capital based on data from Real Capital Analytics. The chart on the left shows China as a source of Asia to global property capital flows. Last year, 2016, you can see that Chinese capital accounted for 44% of total Asian capital invested outside the region. Now, the chart on the right shows China as a source of intra-Asian, so intra-regional property capital flows, and in this case, China was much smaller, accounting for only 19% of the total. If you have a look at the following slide, which is numbered 4, slide 4, this really tells or explains the historic picture of property capital flows since the global financial crisis. in 2008 to 2009, Asia to global property capital flows have risen sharply to reach just under $60 billion last year, whereas global to Asia flows have stagnated at under 30% of that level. As I said, Chinese groups represented 44% of Asia to global capital flows last year and focused their investment effort heavily on the US. Concern about renminbi depreciation was a key factor behind the activity of the Chinese. Between the start of 2014 and the end of 2016, the renminbi dropped by 13% against the US dollar. If you have a look at the chart on page 5, it's a little complicated, but let me explain it. That puts the historic pattern in graphical form. The light blue column shows you Asia to global property capital flows. Back in 2008, Asian investors put only $4 billion approximately into global markets. But by last year, that figure had risen to $59 billion. Conversely, the medium blue shows you global to Asia investment. In 2008, that figure was $25 billion. But by last year, it had fallen to under 17 billion. So the pattern is clear. Outbound capital rising, inbound capital falling. But what perhaps that picture obscures is what you see in the dark blue columns, which is intra-regional investment, intra-Asian investment. Now, for 3 years in a row, intra-Asian investment has been rising strongly, and last year, 2016, total intra-Asian investment actually reached $70 billion. So it exceeded Asia to global investment. If you have a look at slide 6, that shows you where Asian, and in particular Chinese, investors have been putting their money. Traditionally, the main market was the UK, and the UK is still the second biggest destination overall, but the market which has really risen strongly over the past 3 years is the US. Total Asian investment in the US actually dropped about 10% last year based on the real capital analytics data, but still it's very high at around $30 billion in total. Now, what if we look within the region? Look at slide 7. The table rather on page 7 shows you the most active investment markets in Asia Pacific, this time including Australia, in 2016, and shows you year-on-year change in total property transactions. 3 urban markets fell quite significantly. Those were Tokyo, down 40%, and also Sydney and Melbourne in Australia. But other markets saw a significant increase in overall transactions. And the first one to note is Hong Kong, which is the 3rd biggest overall investment market in Asia. Hong Kong saw a 15% year-on-year increase in property deals last year, and that was driven in particular by mainland Chinese interest. Now, it's possible that Hong Kong is a special case. Chinese investors have, both financial investors and developers, have been very concerned about renminbi depreciation over the past few years. They may see Hong Kong as a proxy for the US because the Hong Kong dollar is pegged to the US dollar. So to some extent, Hong Kong is a kind of automatic substitute for the US. The more interesting markets perhaps are Seoul, with total property transactions up 142% last year, and Singapore up 38%. And in both those markets, we saw both strong domestic and strong foreign interest. As I said, in contrast, transaction volumes declined in Japan and Australia. In Japan, probably reflecting a weak economy and a strong yen for much of last year, which deterred foreign investment. In Australia, one of the problems is simply shortage of property assets to buy. Looking forward, what do we expect to happen? To have a view on Asia, you must have a view on the US. Our view on the US economy can be summed up in 3 words: expansionary, then contractionary. It is the view of our US research team that President Trump has inherited a strong economy poised for continued moderate growth. The planned stimulus package of tax cuts and infrastructure spending should boost growth, but at the cost of higher inflation and interest rates. Quite simply, the US economy is strong enough already. It doesn't need a stimulus package. Looking forward, President Trump's broader economic platform should benefit certain key sectors, energy, finance, pharmaceuticals, but may actually cut growth overall and increases the odds of a recession by 2019, particularly if the new administration follows through on some of its protectionist rhetoric. That may not happen after the most recent meeting between Xi Jinping and President Trump, but let's wait and see. Now, the near-term outlook remains firm. That means the US dollar will probably stay firm, at least for this year. That may well encourage US investors to keep capital at home. Look now at slide 9. What does this US outlook imply for Asia? Now, the US economy looks firm right now, but so too does the Chinese. Chinese economic data have beaten most expectations for the past 12 months or so. And given the strength of recent figures, we doubt that the renminbi will fall much further. After 3 years of steady depreciation against the US dollar, indeed, the renminbi has stabilized since the start of 2017. We think it may depreciate a little further, but just a few percent. An Oxford Economics forecast of 7.15 against the US dollar for the end of this year strikes us as perfectly reasonable. Now, if the renminbi is no longer depreciating, Chinese investors no longer have a strong incentive to place money abroad in order to hedge against a declining currency. Political concerns may also slow Chinese investment into the US, especially if the new administration does translate protectionist protectionist rhetoric into reality, and capital controls may also play some role. Now, look at the next slide. What do we think will start to happen this year? We expect Chinese investment in foreign property to continue at a relatively high rate, but to start to shift towards Asian markets. If that is so, then Chinese investment capital should be added to strong capital flows from other sources, Hong Kong and Singapore developers, financial investors, meaning that the overall weight of capital looking for a home in Asian real estate remains very strong. Rising demand or strong demand means rising prices. On the other hand, cost of funds is rising for most investors as interest rates bottom and gradually increase. That force exerts an impact in the opposite direction. That exerts a downward pressure on prices and an upward pressure on yields. Our conclusion, therefore, is that Asian property yields, on average, should stay more or less flat this year. Economies are mostly healthy. Economic news around the world, but including Asia, has beaten expectations over the past several months. We therefore remain broadly positive about prospects for property in Asia and expect another good year in 2017. And we see particular investment opportunities in China, Hong Kong and Singapore, and over the medium term in India. Just before I mention possible investment destinations, let me just say we do think it's probably fantasy to expect an overall reversal in Asian property capital flows this year. We think the big outflows from this region, particularly towards the US, will start to slow, but inflows will only rise gradually. However, that question is now less relevant. Intra-regional investment in property is surging, and China should play a greater role from this year. Let me also just mention quickly initial indications from the first quarter of 2017. Based on preliminary data from Real Capital Analytics, total Asia to global investment in the first quarter was $8.3 billion US. That's down 28% year on year and 55% quarter on quarter. Chinese investment outside Asia was down particularly strongly, 49% year on year and 76% quarter on quarter, whereas Chinese investment within Asia was flat at about $5.2 billion US. It is true that total Asian investment in the US was still rising, 37% up year on year in the first quarter, although down compared to the fourth quarter of last year. Although there are big gaps in the data, it seems that Asian investment in Europe and in Australia and New Zealand right now is declining significantly. Have a look at the next chart that shows you a summary of Asian urban prime grade office markets. I won't go through this in any detail. Suffice it to say that Hong Kong is still seeing quite solid rent growth. Most other cities would see faster rent growth if it were not for a significant increase in supply, which we think will push up vacancy rates and therefore constrain rental growth. Yields have been coming down for several years, and spreads over bonds are now pretty narrow, but we think in some markets they can still fall a little further. In some markets they'll rise a touch. The overall picture is probably flat. The least attractive market on the basis of this chart is Jakarta, where we expect vacancy to surge over the next few years. I've been talking for about 15 minutes. Let me just mention in the last minute or so, very quickly, some opportunities for investors in key Asian centers. Hong Kong, en-bloc and strata title offices in decentralized districts. We would highlight Kowloon East in particular. We have done considerable work on that market this year. Singapore, office property in general, given the country's status as a sophisticated market economy with high regulatory transparency. Industrial property is becoming more popular, and any easing of residential cooling measures should be an impetus for foreign investment in luxury residential property in particular. Shanghai, this is now slide 16, office properties with value-added potential and a size ranging from 3,000 to 20,000 square meters, particularly in decentralized areas like the Hongqiao transportation hub, and logistics properties on the fringe of Greater Shanghai driven by strong occupier demand and stable rental values. Beijing, we see value-add opportunities in upgrading and renovating office, retail, and hotel properties in core areas where large-scale new development has been banned since 2015. You could also look at business parks in emerging areas. And just let me mention at the very end, page 16, India, a market that's off the radar screen for many financial investors and developers right now, but it is the fastest growing major market in Asia, with 10 to 12% annual growth in IT driving 6.5% GDP growth on average. And that means demand for office space should stay firm for the next few years, particularly in the technology-driven markets like Hyderabad, Bengaluru, Pune, and Chennai. I will wrap up there. Thank you very much for joining this webinar. Please do pass on any questions that you have to the ULI team. And of course, my colleagues and I are available for further questions or further contact as you wish. Thank you very much once again. Goodbye.
Thank you, Andrew. And thank you to everyone for joining us. As mentioned, this presentation was recorded and will be sent to all ULI members. If you have not signed up to be a member of ULI, I would encourage you to do so. Please email us for more information or visit our website. We hope you enjoyed the presentation. Again, if you have any additional questions for us, please feel free to contact us. Have a wonderful day, everyone. Thank you.
Thank you. Thank you. Bye-bye.